If you're looking for self-made millionaires, then you might as well turn into Grant Cardone's direction. He's a very, very smart investor, knows how to work the real estate market. However, we're actually going to be going over today why he doesn't invest in stocks, why he doesn't believe in them, and ultimately his secrets of growing successful cash flow on a daily basis so that you guys out there listening to this can make it your daily income. What's going on, guys? JT here with The Wealthy, coming at you with another video. Make sure before the video loads up to leave a like, comment, and subscribe. Also, let us know in the comment section down below if you did subscribe. That way you could be entered in this month's subscriber giveaway, where we shout out one lucky subscriber who subscribes, comments down below they subscribed, and turns our post bell notification on. That way you guys can have a good shot at winning the subscriber giveaway. Now, guys, let's get into the 10 reasons why Grant Cardone doesn't invest in stocks. Our first reason is positive cash flow. Even during the 2008-2011 and the worst real estate crisis in American history, it was impossible to sell your home. It was impossible to buy a cheap house. Apartments, they were actually in the right neighborhoods, and bought right continued to provide cash flow that was positive. However, one of the biggest benefits to income-producing real estate investments, unlike personal residences, is the leases generally secure the assets, meaning the income provided by the renters should exceed the cost of operating the property and leaving enough cash to pay debt and provide investors with a positive return on their equity flow. This provides a regular income stream that is significantly higher than the typical stock dividend yield. I look for properties that can be 10 to 12%, Cardone says, return before I consider any ways to improve either the income or reduce expenses through smart management. This is very smart because he's leaving enough room for them to pay their rent and also fix and manage the house. Get it situated, get it furnished. If it costs more to fix your sink than your rent does, you got a problem there. You got to make sure you provide positive cash flow through in and throughout, all throughout the renter's time while living at that property. That way you can ensure three things: you get paid on time, you get paid the right amount, and you don't have an upset buyer who wants to move out within the first couple of months. Here we have leverage to multiply your money. This is the 4-to-1 rule. Another important characteristic of commercial real estate investing is the ability to place debt on asset, which is several times the original equity. In today's market, you are typically allowed to build a 4-to-1 ratio. This allows the investors to buy 4 times the assets, leveraging currency, which everyone believes is going down in value, to buy 4 times the amount of property that most people believe will go up in value. This is the 4-to-1 rule, like I stated before. If you have a property that you're currently purchasing for $20 million, where you get accredited investors who are putting up 25% of the total price, $5 million is the buying, and a $20 million asset overall. Like I said, the 4-to-1 ratio, if you do 5 times 4, what do you get? You get $20 million. That's what he's talking about in asset funds. You have to make sure you understand this, you leverage to multiply your money ultimately, and you ultimately in total get that filling price filled. It's very, very important once you get that done so that you can get the buyer, the renter, and the investor all on the same page. It'll make for a good future for you guys. Upcoming, we have low cost of debt multiplies cash flow. Investors are paid the difference between costs and debt and cap rate. So while cap rates may be going lower on raising the price of the deal, the spread allows a return of 2 to 4% on the money that is being borrowed. He says he's done deals in every cycle, including the worst. You have to know what you are buying, where you are in the cycle, and have a long-term vision. Placing positive leverage on an asset allows for investors to effectively increase positive cash flow from operations by borrowing money at a lower cost than the property pays out. For example, if a property generating a 6% cash-on-cash return were to have debt placed on its 4%, the investors would be paid the 6% on the equity portion and approximately 2% on the money borrowed, thereby leveraging the debt. That's always not a bad thing. If you have low cost of debt, it multiplies the cash flow, which allows you to put more and more prices on the house. It allows you to increase the cost of utilities, increase the cost of living there. All of that plays an important role when you're dealing with cash flow. Don't ever let that go by your nose. You got to understand that lower debt, and it multiplies. However, when you have a low cost, the debt multiplies, and that's going to leave the buyer unhappy and you as well unhappy, because you may not get paid on time and ultimately affecting your way of selling the house. Next, we have inflation hedge. Money is going down in value, property goes up. Stocks, bank accounts, credit cards, valuations, they're all imagined. What's real is real estate that produces income. Not all real estate is protection against inflation. A house has been considered an inflation hedge But the fact that you have to pay for the house means you are paying for the hedge. In apartments, the renter is paying for you while you have the property inflating. Real estate investments have historically shown the highest correlation to inflation when compared to other asset classes such as the S&P 500, 10-year treasury notes, and corporate bonds. As country grows around the world, continue to print money to spur economic growth, it is important to recognize the benefits of owning income-producing real estate as a hedge against inflation. Generally speaking, when inflation occurs, the price of real estate, particularly multi-tenant assets, will have a high ratio of labor and replacement costs that will also rise. If rent rises, the value of the property will increase because the property is valued as based on its rents. Lastly, we have physical assets better than paper. Paper assets are a risk. If the apartment burns down, insurance covers it. Your dollars are not even accessible at the bank. It's turned into electronic digits. Ask the bank to give you $10K of your money and you will have to fill out a form, probably to have to give the bank a notice to withdraw. Income producing real estate is one of the few investment classes that is a hard asset, has meaningful value. The property land has value, as does the structure itself, and the income it produces has value to future investors. Income-producing real estate investments do not have red and green days, as does the stock market. They never sleep. These red and green days are very, very important to your producing of cash flow, and you got to understand that. If you don't understand that the physical assets are better than the paper assets, you're going to be in for a rude awakening. It's better, for example, to have something in person than on paper. It's like saying, LeBron's going to LA. He's going to win a championship. The team looks good. Okay, they may look good on paper. However, once you see them play in person and they actually show that they're good, that's when the results produce. If you don't have the producing of the results in person, you're not going to be able to get that on paper later on. It makes sense. It's kind of a vice versa turnaround 360-degree mark. However, ultimately, that's what you got to realize. So guys, I hope you enjoyed today's video. Guys, this is JT signing off. Hope you enjoyed today's video like I stated. Also, make sure to leave a huge thumbs up on the video. Let us know in the comment section down below if you did subscribe. That way, you could be entered in the subscriber giveaway for the month. Guys, I'm signing off, and as always, see you guys later.